Hey guys, happy Friday and welcome back. I have been going through the AMC Q3 earnings and the 10Q in detail over the past couple days, and I have a couple of videos coming out for you guys to go over my different thoughts on what we saw on Wednesday and the Go plan. Also, we'll have a video on that. But in this video, I want to talk with you specifically about the spreadsheet model. How did it stack up our expectations from that spreadsheet forecast versus what AMC actually posted on their income statement? In addition to that, towards the end of this video is some very important content that you're going to want to be aware of regarding AMC's debt, the new debt deal, and the risk of dilution. So without any further ado, let's get into that and we'll talk about the changes that I'm going to make to the spreadsheet coming up. One of the most difficult things to do from quarter to quarter is estimate what percentage of the market share internationally that AMC captured. And I learned about a year ago that it's safest to have a low, average, and high estimate. And so we have three different columns that you see here on the spreadsheet. Pink being the low, 28%. Yellow being the average, 30%. Green being the high at 31%. Keep in mind as you're looking at this that I use the domestic box office as a proxy and some formulas to calculate out what AMC's global admissions revenue is going to be. With that in mind and using the column that I have for the low estimate, we actually nailed the box office admissions within $1 million. I had forecast $745 million box office revenue, and it came in at $744 million. For the food and beverage, I was a little bit low. AMC actually outperformed on their food and beverage revenue for this quarter, and I don't mind being low. I'd rather be surprised to the upside. And on the other category of revenue, again, just only $1 million off on the forecast. But at the end of the day, even in my worst case forecast, I had estimated that AMC would turn a slight profit, and obviously they did not. It was negative 6 cents on the GAAP earnings. So in this video, I want to briefly talk to you about the two things that caused that and how the model is going to change to try and get more accurate going forward. Forecasting is always a tricky business, and as we talked about when I put out the original video on October 1st, there were a lot of things that I was on purpose not trying to forecast just because it's almost impossible until we get the numbers from AMC related to that new debt deal and all of the one-time charges related to that new debt deal and the paying off of the debt, the gain or loss from extinguishment of debt, the new interest rate on the debt, all of that I can't forecast. I don't work in the AMC finance department, but now that we have the data, we can use it to make the model more useful going forward. So let's talk about the three major buckets where the spreadsheet was not as accurate as I would have liked it to have been and what changes I'm making going forward. And we're going to start off with this bucket called film exhibition costs in the expense side of the income statement. I generally use an average taken from the last 3 or 4 years of 49%. And so that gave me a forecast of $365 million in this expense bucket. It came in at $381 million, which was 51.25% of admissions and a $16 million miss. I underestimated that expense by $16 million, and that throws off a lot of the numbers as we get down closer to calculating earnings per share. The change that I'm making going forward is instead of using a flat 49%, I'm just going to simply make it a variable formula, which will adjust the expense bucket relative to the amount of box office revenue that came in. And with that new variable formula in place, you can see here in yellow, the new model, we would have only been off by $1 million on the film exhibition cost bucket. The second line item where my forecast was too low on calculating expenses was the line that I have highlighted in orange, operating expense. And if we look at total revenue going back in Q2 of 2023, highlighted in blue, it's very similar to the total revenue for the quarter we just finished, Q3 2024. Back in 2023, the operating expense as a percentage of total revenue was only 30.57%. I have a variable formula that I'm using, and I was estimating a little bit higher than 2023. I was estimating 32%, but that still would have come in a little bit too low. So I made some changes to the formula that calculates the variable cost of OPEX, and hopefully AMC doesn't continue on this pattern of having OPEX at 33.7% of total admissions for box office of this level, because if that is the case, we're going the wrong direction from where we were in Q2 of 2023. The final big bucket that changed here in Q3 was corporate borrowings, which is the amount of money AMC spends on interest every quarter. And we have a long history of knowing exactly what they were spending for their interest payments, and it's typically been around $88 to $90 million. And so I had forecast $89 million. But as we know, with the new debt deal, there were a lot of changes to interest rates and where the debt is bucketized. And I told you guys, don't count on any major savings in this quarter. I know a lot of people were telling you that AMC is going to save a lot of money with the new debt deal. It was actually the opposite. With the new debt deal and the way the interest rates are calculated, AMC's interest expense actually is going to go up. As we see here, $20 million per quarter. We're now at $109 million per quarter of interest payments. And that will go down as interest rates get cut. But this is the new normal for now. Going forward, you can see here in yellow, I'm going to be using $109 million for the quarterly corporate borrowing expense. We can see here in the debt table from the 10Q, in green was the old term loan, that $2 billion that was coming due in 2026. That has now all been moved into a new bucket. All of it is now in yellow and due in 2029. But because of the new interest rate, it is effectively, at least for the quarter we just finished, 11.91%, whereas previously it had been 8.47%. And that is what caused this $20 million increase in AMC's corporate borrowing expense. Good job by the company, though, of taking all of the pressure now off of 2026. They have effectively bought themselves 4 more years until 2029 to allow the box office to recover and improve their profitability. There is one other bucket in the debt table that the company has been attacking, and that is this 10-12 pick toggle highlighted in yellow. Back in December of 2023, you can see on the far right-hand side, almost $1 billion of 10-12 pick toggle. And the company has been attacking that, paying it off, and restructuring some of it, moving the maturities out. And that is where we see now the 6-8 pick toggle, $414 million. So they did achieve a lower interest rate on the pick toggle by making it convertible. That's the convertible debt, $414 million. But it is still overshadowed by the fact that in the new debt deal, the term loans due 2029 have a higher interest rate than the previous term loans, which were at 8.5%. How does the company fix this? How do they get a better rate than 11.9%? Because that seems pretty high, right? We don't want to be spending $20 million more on interest expense. The way that they fix that is continuing to work to pay off debt from the balance sheet. So you should expect that they're going to take whatever steps they can. Listen up to what I'm saying. You should expect that they will continue to take whatever steps they need to pay off debt on the balance sheet. All of those steps are not designed to hurt you. They're not designed to help the shorts. They might hurt you. They might help shorts, but they are designed to keep the company from going bankrupt and to eventually get a better interest rate. Fixing the balance sheet is and should be priority number 1 for the company, and it's up to you to decide if you want to participate in that or not. The other things that need to happen is the box office must continue to grow. The company must post positive income on the income statement. They must post positive free cash flow. And as all of those things happen, if the balance sheet is improved, if positive income happens on the income statement, over time, the company will get a better credit rating and they can go renegotiate this debt at a lower interest payment. Getting back to the spreadsheet changes though, and focusing on what it would look like with the new changes in the yellow column here, it would have forecast a loss for AMC of negative 14 cents instead of a positive 4 cents for the quarter. If I update food and beverage up at the top from 455 million to 490, which AMC is showing a trend to post higher food and beverage, and maybe I will update it if I get a few more data points, that would have brought the number within 3 pennies of AMC's actual results. So let's give this a try going forward. And as always, remember, these are just forecast models. Nobody can provide perfect forecast. We do the best we can. And I, of all the people that are doing these forecasts, try to not provide overly optimistic forecasts, just realistic ones, a low market share, a average market share, and a high market share. And then we see where the numbers come in. Use this as a tool, but always do your own due diligence. And if you have questions about the model, you think something is going to be wrong, if you think the numbers are too high or too low, always give me that feedback. I love to hear from you guys. If you have any questions or comments, please drop them for me down below. Thank you for watching all the way through. I am Tony Denaro, and I will see ya on the next video.